Hello, everyone. This is Andrew Berman from National Mortgage Professional Magazine. You are watching Mortgage Leadership Outlook, the show that started at the beginning of this year when we were looking for leaders who can give us some guidance, give us actually some kind of expectations of what we could see with this year as we face some crazy uncertainties. One of the first guests that we had on was Barry Habib, who kind of gave us an idea of what we can expect for the year. I'm so excited to have another leader joining us today, Mr. Dan Habib, Executive Vice President for MBS Highway. Dan, thank you so much for joining us today.
Thanks for having me, Andrew. Pleasure to be with you.
So listen, I think actually you have like this interesting perspective because I know. Now, first off, just if anyone's just starting to watch this, we are going to talk about rates. We're going to talk about rates where we're going. We're going to talk about rates where they're going to be next year. We're going to talk about production. We're going to talk about, of course, actually what you could do to set yourself aside as we, eventually rates will go up. What we could do actually to make sure that we're still kicking butt. So we're going to go into that. We're also going to a little bit about actually, I'm live. Yes. I'll see you later. Sorry. The disadvantages of having the in-home studio. So, but I want to first actually, go into your story. So Dan, you grew up with Barry Habib. Someone actually who in this industry we love, and actually, there's no question about it. Barry has influenced so many people's career in the mortgage business, and I've already seen you do that. So let's talk a little bit about actually, how Barry, influenced you growing up.
Well, yeah, I really didn't have a choice getting into the mortgage business. It was kind of by default. I guess you could say it was in my blood. As a little kid, I have fond memories and vivid memories of my twin sister and I, literally hanging out with my dad and running through the office, racing through the office while he was in his originating days and crushing it then. But from there, I worked with him for many years, doing kind of office duties and things like that. And then eventually, as I got older and went to school, I recruited my whole fraternity in college, actually, to then work for his company at the time, which was Mortgage Market Guide. Obviously, now we are MBS Highway, but created the sales team there and had a bunch of fraternity brothers there, and we were crushing it. And from there, Barry had left there, and we had left, and I went and worked at Morgan Stanley as a financial advisor for several years, and had the honor of working with Ed Moldaver and Wayne Krebet actually on their financial advising teams, the #1 Barron ranked team in New Jersey.
Wow.
And then once we started MBS Highway almost 8 years ago, really kind of came in on a different level with my father, Barry, and really kind of helped him build this company.
So talk to us a little bit. Let's go back into history here. With Mortgage Market Guide, because Mortgage Market Guide just created a need that we didn't even know we needed. As an industry, it was crucial, especially since back then, originators got compensated. It wasn't just actually on basis points. We got compensated on the profitability of a loan. So
this was before Dodd-Frank. So
exactly, yeah. So it was we wanted to do the right thing for our borrowers to make sure we got them the best deal, but we also wanted to make sure that we maximized our opportunity. So talk to us a little bit about how you guys created something that the industry didn't even know that they needed, and now they can't live without.
Yeah, so this was around 2001. So I was a little bit on the younger side when he had created it. But, Barry being a successful mortgage originator, top originator in the country on multiple occasions, I think he had a really good understanding of what an originator needed to know and to do in order to be successful. And one of the things that Barry always believed in was understanding what's driving the market and being a student of that and really truly embodying being an advisor. And he really learned a lot from Steve Nissen, actually, who brought over candlestick charts from Japan, first one to do it to bring it to the U.S. And he was able to really kind of forecast where rates were going. And as you mentioned, this was before Dodd-Frank. So it was really quantifiable for originators. And, in order to know ahead of when lenders were going to reprice, instead of not only doing the right thing for your customer, but they can make a lot more money, right? So he saw some technology out there that allowed him to get these alerts out in a timely fashion and it was kind of like the first of its kind at the time. And remember, this was somewhere back in like 2001 area. And I remember he actually sat me down in his family room. I'll never forget this talk. And he's like, Dan, he goes, I've been really successful originator, and I think I know what they need to know in order to be successful. He goes, this would be a big move. He goes, but I think I want to start this company, Mortgage Market Guide. And I think it's going to be successful. But he told me, there's a difference between, being smart and being successful. He says, a lot of smart people out there, but the difference is you just got to go out there and do it. And sure enough, he went and, created Mortgage Market Guide, and it became a big success, and ended up selling the company many years later. But it was, my dad has always been my hero and kind of role model. And, every step of the way, he's always just won. So it's been someone that really great for me to learn from and look up to.
Yeah, listen, it's someone we've all learned from and all have looked up to as an industry. So, it's great to actually have, exclusive access like you guys did. Let's talk about this year. So here we come, actually, coming in March. Listen, your service was important before March, but with the volatility that we saw, in the industry, where we saw actually, rates reacting, and sometimes actually in a way that corresponded to to treasuries, but it did some things this year that we never have seen it do before. Some of those things are artificially done by lenders to kind of keep volumes. So talk to us about the importance of using services such as MBS Highway for 2020.
Yeah, well, especially, in like the February, March, April area, there was massive volatility going on in the markets. And, I'm honored and thankful that we were actually credited somewhat with helping to really kind of save the industry, so to speak. And the reason being is because the Fed came in, and amidst all this, they were really trying to help to stimulate the economy. And they were buying a massive amount of mortgage-backed securities to try to keep rates low. But they still are buying a lot, about $100 billion a month, but they were buying a ridiculous amount. And what people didn't understand is that this caused a big problem for companies. And you really have to understand how really rate locks truly work. When somebody says, lock in your rate at 3%, there's not like some magical mechanism that they're clicking on that will actually lock that rate in. What happens is that the company is basically promising that customer that you're going to deliver a 3% rate at closing. But of course, we know that rates can move up and down, right? So how does a company protect itself from rates moving higher? Well, what they do is they short mortgage-backed securities. It's called hedging, right? So every secondary capital markets team does this. Well, the Fed bought so much in mortgage-backed securities that they caused mortgage-backed securities to rise precipitously really, really fast. So their short positions were so underwater that they were actually getting massive margin calls. Some companies were getting margin calls of like $10 million a day. And they were like, I can't sustain this for much longer. So we actually got in front of the Fed, and we did this through our connections with people like Peter Buckfar, John Malden. We actually had a late night Zoom call with Steve Leisman before he broke the story to CNBC. And we explained all this stuff. And the Fed actually curtailed their purchases back from the massive amount to a very, very even keel level where you got to give them credit. If you look at the mortgage-backed security chart from like March on, it was very, very flat. So they were really buying like a Goldilocks amount, which kept the market stable, but it wasn't too much where these companies were getting these crazy margin calls. So a lot of people credit us with somewhat of saving some of the mortgage industry there. But it was a crazy time. But to answer your question, yeah, it's always important to be an advisor, and it's always important to understand what's happening in the market and be able to do the best for your customer. But especially during volatile times, I think people really turn to us because there was stuff going on that people just didn't understand. They couldn't explain. And, we were doing all kinds of videos and calls, and Barry was really stepping up to the plate and really kind of educating everybody, because it's amazing. I would say less than 1% of people really truly understand how the mortgage market works and the intricacies with servicing and everything like that. So we were able to really kind of break some of that down.
So, and you feel like 1%, is that like 1% of our industry, or 1% of like the world?
Well,
I'm scary. It's the former rather than the latter.
Yeah, part of the reason why we created a certified mortgage advisor, which we could talk about a little bit, it's a new designation that we came out with. It's just because there's so much about the mortgage industry that you would think would be taught to originators, right out the gates. You're getting your licensing and you're, learning about the industry. Nobody teaches them how, locking rates work, how servicing works, how the actual mortgage cycle works. What happens when I do someone's mortgage? How does that kind of flow of funds go? Where are rates coming from? Nobody understands this stuff. So it's something that we really broke down for people.
Yeah. And so listen, Barry has always talked about being the trusted advisor. I mean, it makes so much sense actually, to be actually a trusted advisor in a world of where if you're not, you're a commodity. I mean, there's nothing, there's no value you're offering if you're just taking an application and delivering rate. I mean, so, to be that trusted advisor is where you separate yourself, from just being a commodity. Just today, actually, we had actually a major brand actually launched, a partnership with Mint. So how do we actually make sure that we're separating ourselves? You guys, with the CMA, I want to, if you could talk a little bit about it, but about what the details of it, but you've actually quantified what a trusted mortgage advisor is and put some teeth into that.
Yeah, well, this year everybody's busy, right? And everybody's going crazy because you just have so much refi business going on, and it kind of masks, some inadequacies that you may have. But listen, invariable things are going to change, right? I mean, rates are going to eventually move higher, and we can get into a little bit about where we see rates going in just a little bit. But if you're just an order taker, if you just know how to put a loan transaction together to approve somebody, you're at risk of being replaced by technology. And you mentioned that thing with Mint. There's a lot of other companies that have either gone public or gotten massive amounts of money. And these fintech companies out there, they're not going to be stopping. They think that they can do the mortgage process cheaper, more efficiently, and quicker, right? And they think that, they can just kind of replace that whole interaction. And, if you are not really truly an advisor and adding value, well, you might be at risk of being replaced. But, one thing that you can't ever replace is really true wisdom and knowledge. And, then there's always going to be a need for that. But you got to make sure that you're not just using that as like a tagline, like, hey, I'm a trusted advisor, but you got to make sure that you truly embody it. You need to make sure that you understand what's driving the market and what's driving rates. And, rate's not the most important thing out there, right? Strategy is important, but, I've never heard somebody say rate's not important. Customer, give me whatever rate you want, right? Rate's important. You need to be executing that rate too, though, right? Knowing when the best time to float or lock is, right? I mean, you don't want to lock a loan and then all of a sudden rates get better, right? That's not going to be a good situation with your customer. They might jump ship. But the strategy is important too, and you need to really understand how the mortgage process works, but how you can use the mortgage as an asset, how you can use it to plan for your customer's future, use debt consolidation, different things like that, and really just not be that order taker. And if you're doing that stuff, then it's going to be very difficult to be replaced.
Yeah, a mortgage is not just actually a way to buy a property without actually using all cash. I mean, there's some great tools within that mortgage, and knowing actually how to use that and position it as a wealth creation tool is what's going to separate you aside, from any kind of app-based tool. So I think that's super important to see actually, to finally see like a curriculum that's put into place that quantifies what Barry's been talking about the trusted mortgage advisor. So what goes into it? Like, so if I want to become a trusted mortgage advisor, what do I need to do to become that trusted mortgage advisor?
Yeah, so the course,
the certified mortgage advisor.
Yeah, so the course we created is CMA, Certified Mortgage Advisor. And it's something that we're really proud of. There's really no content out there like it. And it covers the gamut of really understanding the mortgage process, like I was talking about, right? What actually goes on when you're doing somebody's mortgage, the locking process, being able to combat things like APR, different strategies, debt consolidation, truly understanding how to analyze refinances and such, to things like the Fed. Why do we have a Fed? And really, if you watch MBS Highway, every day we go through this kind of stuff, but this is really taking it much, much deeper and really kind of giving you the foundational levels of pretty much like everything Barry's learned over the last 35 years in his career, and then making it actionable for you in the mortgage industry. Even things like technical analysis, really making you an expert on candlestick charts, on Western technical signals like support levels, Fibonacci levels, right? Support and resistance, and the candlestick patterns as well. But things that'll help you in your business and help you when you're trying to advise your customers, but will also help you in your personal life with your own investments. So really, like, everything that they should teach you in the mortgage industry about how things work to be really an advisor. And we do it in about 9 hours of content, I'd say. And we've broken it down into a manageable online course. Eventually it was supposed to be like a couple day events that we were going to do in person. And obviously, due to the current environment, we weren't able to do so. So we went to Atlanta, and we went to this really cool studio where they filmed Housewives and some other TV shows, some Netflix shows. And the reason why is because they're like one of 3 studios in the country that have this technology where it makes you kind of look like a digital person. It was all green screen and stuff on top of like the slides, and it just looks unbelievable. But we broke it down into like 28 different sections, and you can do it at your own pace. So listen, everybody says right now, I'm so busy, I'm going crazy, right? But at the same time, I hear people talking about binging Netflix shows and things like that. So if it's important to you, you'll make time, right? But we wanted to make it easy. So you go through these different courses. There's 5 main modules. And at the end of each section, you're going to have like sample quiz questions. And then you have to take a test at the end of each of the 5 modules. And you have to pass all of these. And after you're done with it, you are going to get your CMA designation, which you can market. But the education is really what's key and what you're going to get over that course. So
why do I have to learn what a bullish engulfing pattern is if you're going to tell me what a bullish engulfing pattern by subscribing? So I'm curious, like, because you guys provide so much of the tools. Share with it actually, why that's important to actually understand the mechanics of it, not just be able to speak the jargon.
Yeah, so we cover, at I'd say more of a base level, some of the things in MBS Highway, right? I mean, we don't have too much time in our daily update to really go nitty gritty on a lot of those different things. And we do a great job of monitoring the market for you. But, if you really want to have an understanding and you really want to sound like Barry and you want to take it to the next level when you're talking with your customers.
Or Dan.
Say that again?
Or Dan.
You really need to have a fundamental understanding of it, right? I mean, you might be able to kind of explain some of the stuff that we do, and we try to make it digestible, but it takes it to a different level if you truly have an understanding for it. And like I said, you can use it in your own personal trading, but we're not going to go very deep in each of those daily videos on the different candlestick patterns. We might highlight one here or there, but you can really go in deep and take a look at these things. And more importantly, you can better explain it to your customer because you'll really understand what's going on and not just maybe parroting some of the things that you're hearing. You understand, the different patterns and what's going on.
Yeah, so you're not just repeating actually what you just heard actually at a recording. You're understanding it and maybe actually being able to explain it before you or Barry do the updates and give me the call on my phone to let me know that that's what I should be telling my clients. That's very cool. That's nice. I think that's great. And I think actually so well I can listen to what you guys say and repeat it. There's a level of confidence when I actually know it and I'm saying it and I'm actually having conversations about it. And when people are asking me follow-up questions about it, and especially if I'm starting to get with some analytical people who are going to actually ask deeper questions, that's super powerful. So that's great. Just some nice feedback. We got Mike saying Dan rocks.
Thanks, Mike.
Of course, a shameless promotion from Diana. All right. Thank you. And all right, so this is getting a little personal here. This is Joel Berman, my mentor and dad.
Hey, Joel.
So does working for your dad set the bar higher for you than what your dad would expect from another team member?
I would say yes, but I will say this. My father expects everybody to be at like their top level. You know what I mean? He's always kind of led that way, and it has not been easy at times. Let me tell you, my dad could be the nicest guy in the world, but he works his butt off, and he expects everybody to elevate their game to kind of what he's doing, right? So if you're not, he will certainly let you know. But being his son, I feel like it almost might be a little bit harder almost, because he's also my father. So, he's always expected a lot of me, and he's always been hard on me, but I can't exactly be upset with that because I wouldn't be where I am today if he wasn't, right? So, Yes, I'd say it's a little harder.
Thank you for the comment about my hair, Megan. I appreciate that. Yeah, listen, because there's one person that knows, actually, your truest potential better than anyone else, and that's Barry. So I totally understand that. So that being said,
You must have a similar situation, I'd assume.
Yeah, yeah, totally, 100%. And and it's great. It is great because like you and I were talking before, like a personal trainer will push you beyond actually what you think your limits are. And our parents, especially our fathers, actually know how far they could push us and our true limits.
I will say on that note too, I mean, it presented a challenge for a while too, and I'm sure you could probably relate to this. But our fathers have done such a good job, right? That there's a bit of a shadow there, and there's some obviously really big shoes to fill. And I remember, for a while, I'd say that I've been successful in kind of trying to create a little bit of my own name, thankfully. But my dad was such a big figure that for a while it was like, oh, you're Barry Habib's son, and I'm like, I don't want to be Barry Habib's son. I want to be Dan Habib. Right. So definitely created a little bit of an obstacle that it's hard for people unless they're in it to really explain, but something that you want to make your own name too. So definitely was great. And he's the best teacher ever, but you want to try to make your own mark.
Yeah, well, something, and I think actually, I don't listen. I'm going to be frank. First time that that I was going to hear you speak, or I think actually I was interviewed. I was like, all right, I guess we're gonna hear actually, what Barry Habib light sounds like. But holy, it's a completely different, actually, a different personality, different person, and clearly, actually, there's no if you weren't Barry Habib's son, you would actually, your name would be huge. I think actually, because you have the ability to be actually part of a team that Barry's a part of, you're able to kind of focus on building the company and not being out there as much. But I'm just glad that we get to see more and more of you, get to see more and more of your expertise shared with the industry, because there's no question about it. You know what's going on, which leads me to my next question.
Well, thank you first.
And where are we going? Where are we going? Are we so next 0 to 3 months?
Okay.
Talk to us about what a mortgage rate's going to look like.
So right now, mortgage rates are really, really attractive. And while it's hard to kind of pinpoint an exact time frame on what's going to happen with rates, I do think that there's a potential in the near term for rates to move a little bit higher. Do I think they're going to get crazy? No, but I do think that because of inflation, we could see rates move up. So first off, inflation is like the arch enemy of a bond, right? Let's say that, you're getting 2% on 30 year. Let's say you're holding a mortgage, right? And you're getting 2% return. Well, if inflation's on the rise and you have this thing for 30 years, well, that's going to erode the value of that fixed rate of return. Let's say it's a $100,000 mortgage you're holding, that $2,000 return. Well, you're not going to be able to buy the same amount of stuff in a year or 2 years or 3 years or 5 years or 10 years, right? Inflation's going to erode that. But if you're in an environment where inflation is at an accelerated pace, right, and inflation's moving up quicker, well, the investor is going to demand a higher rate of return to combat that faster erosion of inflation. So anytime you see inflation starting to rise and it's starting to pick up, typically rates will move higher with it because of that, right? So we think that we're going to start to see a little bit of a spike of inflation, and we've already started to see it. If you look at the Fed's favorite measure of inflation, which is personal consumption expenditures, or PCE, the core rate, which is what they focus on, it strips out food and energy prices because that's what they can control, right? They can't really control what happens with food, with different weather issues, famine, whatever it may be, or energy prices, different geopolitical tensions and things like that. But the core rate they can influence with monetary policy. Well, it's recently moved higher to 1.6%. Now, the Fed has said their target is 2%, but we think the PCE is a little bit of a bad inflation gauge because it doesn't have a big weighting on out-of-pocket medical expenses and the cost to put a roof over your head, right? Rents and the cost of purchasing homes and things like that. So we think the CPI, which is running a little bit hotter, is a better gauge, the consumer price index. That's at 1.7%. All of these things are weighed down a little bit because rents have been going down so much in all the different cities out there, right? Because of COVID, people are moving out of all these big cities and they're moving into more rural-like areas, places with more space. So you see, especially in the major cities, rental prices dropping significantly. So that's kind of weighing down what I think the real inflation is, which is higher. But if you think about what's happening in the economy, you have things starting to open back up, and you have, more demand that's going to be coming, and supply chains are not going to be able to keep up. You have, number one, a lot of them supply chains have been compromised, but also labor. A lot of people aren't incented to come back to work because they're receiving unemployment benefits, or even after those expire, or if they weren't normally going to be allowed to use those, they sign up for the pandemic unemployment assistance, which is for another additional 9 months. So, not a lot of people might say, hey, I'm just going to collect these benefits and not go back to work. So the bottom line is I think you're going to see more demand than supply, and you're going to start to see inflation creep up a little bit, which could cause rates to bump a little bit higher. Nothing crazy, but it's something to keep in mind, because I saw some interesting stats recently where almost like 69% of all mortgages are below 4.5%. And as you guys out there do more and more refinances, that number is going to increase. So, it doesn't take rates to go up that much for, almost 70% of refis to kind of no longer be in the money there, or no longer, make sense to refinance, right? If you use that rule of, hey, you got to save 0.75%, rates don't have to go up too much, 3 3/4 or so. And you kind of be right on that cusp. It's a little higher than that 4%, then 70% of refis will be gone. So, that number will keep increasing as you guys do more business, but it's just something to keep in mind. And I think this year, everybody looks like they're crushing it, right? But if we do see rates go up, then you better make sure you're focusing on your purchase business, and you better make sure that you're really being an advisor to not only combat, your competitors out there, but also the fintech companies, and to really make sure you bulletproof your business into 2021. Now, longer term, I think rates are going to remain attractive for a very long time, because I don't think you're ever going to see a 6% interest rate in any of our lives. I think that you could see a modest bump higher in rates, but ultimately they're going to be kept down by the massive amount of debt levels that the U.S. has incurred. So, it's been thought from people out there in history that, hey, when you have massive amounts of debt, that means that you're going to have rates move higher. However, it's really incorrect. And if you look through every country out there, and Lacey Hunt, one of the smartest economists out there, really kind of broke this down for me, and I know has had extensive talks with Barry regarding it. But when you have massive amounts of debt, like the U.S. has incurred through all these stimulus things that we've been doing, it has a downward pressure on what's called the velocity of money. When you think about credit, what you're doing is you're taking like a future purchase and bringing it forward, right? So like, if you're not going to save up to buy a car in cash, you're going to use credit so you can buy it today, and then you have to make that payment every month going forward, right? So that's going to limit what your future purchases are going to be, because you pulled that forward and now you have that obligation. Well, it works similarly with a country that now has $36 trillion in debt, which is crazy. We throw around the word trillion. It's a massive amount of money, but it's going to have a downward pressure on the velocity of money, and it's going to have a downward pressure on rates. So our short-term, to make it short here, our short-term forecast is we could see rates bump up a little bit. So if you have customers out there that are being cavalier about refinancing, make sure they get either their docs and they get it done. And don't wait. Don't tell them. Don't have them wait because they think rates are going to get better. If anything, we see a little bit of risk for them to maybe move up a little bit, but ultimately, long term, I think it's going to be a very attractive environment for a long time.
So does our public debt crisis could that ever lead to deflation?
I don't see deflation really happening, but technically it could, but I don't think that we're going to really see that. I think that, right now the risk is more of a little bit of inflation, at least until we see that demand and supply dynamic kind of flush itself out. But at least for a time period, I think you're going to see a lot more demand than supply, which, for economics, it'll cause prices to go up a little bit.
Fantastic. So all right. So the winners this year is like anyone who's doing mortgage this year. Clearly, we just did our last week's Mortgage Leadership Outlook. We had Ben from Mobility RE that shared with us that there's already 41 originators that did over 1,000 units this year.
Yeah, it's crazy. And I think you had said earlier that like nobody's ever done that before.
Yeah, I don't know anyone that ever has. I know anyone that ever has, and I know, listen, there were people actually that were excited to hit $1 billion career volume, and if they hit $1 billion of career volume, that was like took people decades to get to that point. And there are originators that have done $1 billion in business already this year.
Yeah, that's crazy.
So talk to us, a little bit more about, what originators can do to make sure actually they're going to win 2021.
So first off, what you're saying there, reminds me of like a story that my father told me, and it has to kind of do with putting limits on yourself. There was a guy, Roger Bannister. He was a famous runner, and they had said back then that it was like physically impossible for a human being by like physicians and stuff to break the 4-minute mile mark. And, for the longest time, nobody's been able to do it. Everybody kind of just thought it wasn't possible. Well, one year he broke it. And, wouldn't you know it, that same year, like 24 other people did after him. So it kind of it goes to show you that like we put limits on ourselves, right? And that we really have a greater ability to do more, but we kind of place these ceilings on ourselves. And then once you see it's possible, like you're saying, people doing 1,000 units, then you said you saw how many people do it this year already, 20 something people or so. I mean, it's crazy to see, but just goes to show you, hey, and you're planning for 2021, set your goals high. Yes, you could see potentially a little bit of a slowdown in refi business, but you got to make up for it. You got to make up for it in purchases. And, the way to do it is just to get better. I mean, listen, one of the things that we try to do every day is to get better for our customers, right? We owe it to them, and, you owe it to your customers to do the same. So, keep getting better each day, setting high goals. And I think in 2020, one of the best ways to succeed is going to be really truly being an advisor, like we've been talking about, and educating your customers on what's going on, and doing some of this strategic stuff and some of this planning, and being able to articulate the financial opportunity that exists in housing, being a debt manager. So I think all that's going to be really important. And I think that, if you see rates bump up a little bit and you see, some of these kind of people out there that are maybe just order takers, it'll really give you a chance to shine and kind of separate yourself from some of these individuals.
Fantastic, man. Great pieces of advice there. There's definitely there's a formula to be able to continue to win. I mean, I think the MBA is forecasting that I think it's about 800 billion less in overall volume. Don't quote me exactly on the numbers, but what is going up is purchase. Purchase actually is good. We're going to be doing more purchase business in 2021 than we did in 2020. So there's definitely some great opportunities to continue to have some great things. Since we've already broken the 4-minute mile, you did it once, you could do it again.
Yeah, I think purchase is going to remain really strong, and I think housing is going to remain really strong. It's funny, you see some of these people out there in the media, especially, they talk about things that they just don't get it. They're not good at math. They talk about, I just saw some article that they think home prices are going to go down 30, 40, 50% in 2021. And it's just like, what are you looking at? I mean, if you take a look at all the demographics out there, it's just a recipe for supporting home prices. I mean, you have record low inventory levels. You have builders with increased costs because of all the demand and shortage of labor, having a hard time keeping up with demand. On the demand side, you see a ridiculous amount of demand. Now, a lot of people are attributing that to COVID, people moving out of cities and stuff. And while that plays a little bit of a part, we forecasted this well before this due to demographics. I mean, if you just look at the people, the millennials turning that first time home buyer age and coming to market to either buy or rent a home, you are at some of the highest birth rates, if you look back, let's say 33 years ago, that we've ever seen in this country, rivaling, those of the baby boomers and such. And it's increasing for like the next 5 years. So just demographically speaking, you're going to just have, it's already happened, these births, right? You're just going to have a greater amount of people coming to the market. At the same time, you have really tight supply. And so I don't got to tell you guys, I mean, I think that you're going to continue to see that imbalance in demand and supply. And I think that home prices are going to do really well next year. There's some forecasts out there, CoreLogic says they see it being pretty much flat, but just 2 months ago, they forecasted like a negative 6.6%, which they've revised significantly. Obviously, they were way off. And, you look at some other forecasts out there that some of them are in line with us. If you take a look at Ivy Zelman, who's one of the top 10 housing analysts in the U.S., we think you could see somewhere around 5% appreciation as a whole in the U.S. over the next year.
Fantastic. So we got a question from Carla. Carla, what is your forecast when forbearance ends and foreclosures resume? Keep in mind unemployment rates.
Yeah, so a lot of the forbearance plans that were done in April, you're starting to see a lot of the numbers like improve on forbearances because you're seeing like people that could opt in for like another 6 months. The first 6 months term is up. They're falling off. I think we just saw like 650,000 people fall off that, and we saw the forbearance numbers improve significantly. And then over the next 30 days, you have like another 850,000 that are expected to fall off. So I think those numbers will improve. I don't think it's going to be as big of a problem as everybody's saying, because you have to remember that people have equity in their homes, right? And people are going to fight to protect that equity. And the average LTV out there is like a 53. The average amount of equity is like $177,000 of equity in their home. So listen, people are going to fight to protect that equity. I mean, if they have to sell their home or whatever they have to do, I think they're going to do that before foreclosing, right? But I also think that, there's options with these forbearance plans now. We know that they can take that and put it onto the end of their mortgage. So they don't necessarily have to worry about that forbearance period, right? Now, of course, unemployment is something that has to be looked at. And unemployment has been improving. The latest data was like 7.9% or so, which that's been getting better. We think the real unemployment rate is higher than that. So, yeah, can that affect it a bit? Sure. But I just think you have too strong of a housing market for it to have a negative impact on home prices. When you look at the demand and the supply and the equity people have in their homes, I just don't see it.
So do you think actually will the election going either way have a major impact on rates and volume and our overall economy?
Yeah, so I don't know that mortgage rates are going to really suffer no matter which way they go. Yeah. And I don't want to get political here, but I will say that typically the markets don't really like change, right? So if, let's say, Trump were to stay in the office, I think that no matter which way you go, I think that the stock market will like that. I think that if Biden were to get elected, I think you could see some really scary stuff happen in the stock market. And again, not getting political, but think about this, okay? If you take a look, I recently took a look at Biden's his plan for taxes. And what he said is that he wants to double the capital gains tax, which is like, let's say around 20%, right? So if you think about all the investors out there that have held stocks for more than a year, well, what do you think they're going to do if all of a sudden they're going to get taxed an additional 20%? All these people, if you're smart, you're going to sell your stocks before the new tax laws go into place. Well, if you have all these people in the market selling your stocks, you could have a crash. So, again, I'm not saying which way we lean here, but just based on the plans that I see out there, you could see a really big problem in the stock market if, that were to occur.
Yep, I'd say so. Man, that's a great point. Certainty is good. That's good. So just a call or follow up. What do you think real unemployment is?
Well, here's the thing with unemployment, right? So interestingly, when you get the jobs report each month, they have two surveys within there. One is the establishment survey or the business survey, and that's where they get the headline job creation number for. Right. So we created 600-something thousand jobs in this last report. And the way that they get that is through a lot of modeling and the birth death ratio of businesses. But then they also have a separate survey, and that's called the household survey. And that's where they're literally like calling or visiting like 60,000 households in the United States and asking them questions on if they're employed and things like that. So the BLS said 7.9% is the unemployment rate, but you have to remember there's some weird things that go on there. Now, if you don't look for work for more than 4 weeks, they remove you. So you're unemployed still, but you're considered like a discouraged worker. And if you haven't looked for work, then you are not counted in either the numerator or the denominator in the unemployment rate, but you are in fact unemployed. So that would increase it by a few percent. Also, if you're working part-time, but you'd rather work full-time, they don't count you either. Yeah. They count. So there's a lot of weird things that go on with that. There is a different unemployment number. Now, the main one that you'll see in the headlines is called the U3, and that's the one that everybody reports on. It's 7.9%. But there's also something called the U6, and this includes those other people we were talking about, and that one's much higher. That one's like 12 to 13%, somewhere in that range. And I think that that's more indicative of where we really currently are.
And now, what is that? What is the U5?
U6.
U6. I'm sorry. What is the U6 normally? Like, what was it same time last year approximately?
Yeah. So when we were at let's say 3.5% unemployment, which was like the U3 where we were before this pandemic, right? Yep. The U6 was a couple percentage points higher, maybe like around like 6% or something like that. So it typically does run hotter because it includes all those things that aren't included.
Yeah. And is it more volatile than the U3?
Yeah, I mean, they've both been very volatile, I guess you could say, right?
Yeah.
But it's always higher because it kind of factors in all those things that I think should be factored in because, let's face it, let's call a spade a spade. They're not working. Yeah. So.
Yeah, what's the reason that we don't use that we're still using the U3? Is it just it's scary to adjust to that because everyone's used to using that old number, and all of a sudden if we're changing numbers, the news reports they love those headlines.
Yeah, for some reason in their methodology, they think that if they only want to measure the people that are looking for jobs. They don't want to measure the people that aren't looking for jobs in the unemployment rate. So they don't include them in the labor force, which I don't really truly understand the real reason why they do that, because I just don't think that that's an accurate measure. But I wish I had a better answer for you on why they actually look at that one mainly. But it is what it is.
Yep, we're using logic. That's what is. So, all right, Dan. Listen, thank you so much. I really, really appreciate it. You've shared a lot. You've given us a path on how we could not only say we're a trusted advisor, but how we could have a piece of paper that proves that we are a trusted advisor. You've given us some insights as far as rates, and fortunately we've got actually a little bit of time actually where we can continue to see low rates. You've shared some strategies on what we could do just to kind of make sure 2021 is going to be continued success for us as originators.
Well, thanks for having me, man. It's been a lot of fun, and always love chatting with you.
Dude, great hanging with you. Really appreciate it. And thank you so much for joining us for another Mortgage Leadership Outlook, where we come to you live every Wednesday, 4 o'clock East Coast time, 1 o'clock Pacific time. Thank you for joining us. And Dan, stick around when I take everyone out.
Sounds good.